Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We're live every Wednesday evening at 6 p.m. and we also replay on Sunday evenings at 7:30. And if you get a chance, make sure you listen to my live radio show. It goes for 2 hours on Sunday from 10 a.m. Eastern to noon every Sunday throughout Florida. Go to my website, reznywealth.com, for a list of stations and available questions also you can send us. We'll get those answered not only on our TV show, but also our radio show. We've got a lot to talk about today. So again, if you have questions about your portfolio, we're going to open up our phone lines right now. Best thing to do is call the number on the screen. One of my producers will take your question, and then I'll read your question on air and answer your question on air. So call right now, 239-417-4711. We'd like to hear from you, the TV listener. I know you have a lot of questions about your portfolio, your retirement. Maybe you've lost money. Maybe you're just not getting the return you think you should. Maybe you're concerned about risk. I want to talk a little bit about that today. We have received dozens of phone calls in the last few weeks alone, primarily around bonds and fixed income investing. And I want to stress to all of our TV listeners that you ultimately are going to make the decision, the kind of risk you're going to take with your portfolio. But unfortunately, many investors do not truly understand the risk they're taking with bonds or bond mutual funds. The problem today, with rates being as low as they are, in just the last month or month and a half alone, we've seen interest rates go up about 3/4 of a point. That 3/4 of a point has made and caused many investors who are overweighted in fixed income investments, individual bonds or bond mutual funds, to lose 5, 10, 15% of their portfolio. That's a substantial loss. In fact, that's a bigger loss, or as big a loss as we've seen in a long time, from the stock market. So when somebody tells you fixed income or bond mutual funds are safe, unfortunately, folks, I think the biggest risk today to retirees is being on the wrong side of the fence. At Rezny Wealth Management, we run a very adaptive investment strategy. I can tell you that we've been reducing substantially our exposure to traditional fixed income. And I think too many investors today own too much fixed income. The economy is slowly getting better. I firmly believe the biggest risk to most retiree portfolios is not making a return on your money and losing principal from having too much money in bond, mutual funds, and in fixed income. I know a lot of you are probably opening your statements from last month, and you're probably realizing, holy cow, I didn't realize bonds could go down 6 or 8% in a single month, and they sure can. In fact, if I look at the long treasury, that was down somewhere between 12 and 14% over the last 6 weeks alone. These are the safest investments, supposedly, in the world, but they do fluctuate in value. So again, what you pay and what you get in return is going to be the big determining factor in the future. So one of the things I want to warn all of investors is make sure you understand which side of risk you truly have in your portfolio. And if there's too much money in bond or bond mutual funds, you may be exposing yourself to the ultimate risk, loss of principal over a long period of time. I want to take your calls. I'm going to go to my first call right now. Sal in Marco Island, Florida. What do you think about gold? Oh, Sal, let me tell you what. I hope you don't own gold, and I would not recommend gold at all right now. In fact, we owned a gold position back in December of last year, so well over 7 months ago. We actually sold it at the end of December. One of the things we do within our system at Rezny Wealth Management, we're an active money manager. We don't believe in set it and forget it. So as we ranked all of the sectors that we track in the universe, gold was actually towards the bottom. We sold gold back in December of last year in 2012. Since we sold gold, gold's down about 24% in value so far year to date. Gold is in a very negative downtrend. There's an old term called a trend is your friend, and right now, gold is not your friend. I ultimately believe small investors piled into gold over the last year or two only to have big losses handed to them because they bought gold after it already made its major run. Now it's in a downturn. I try not to give predictions where gold's going to be or any investment's going to be in the next 6 months or year. But if I look at gold, I wouldn't be shocked if over the next couple of years we see gold trade under $1,000 an ounce. Now, if gold becomes relatively strong again, Sal, and it goes back into our top rankings, we may add it back to our portfolios. But right now, it's still at the bottom of our rankings. It's relatively weak. And in fact, it hit a new low last week and again this week. If you're like Sal and you have a question about your portfolio, please call me right now. We only have a 30-minute show today. I want to answer as many questions as possible. Larry in Naples. I'm worried about rising rates. Most of my money is in the PIMCO Total Return Fund and the Oppenheimer Rochester Muni Bond Fund. Larry, you better be worried about rising rates. First off, I want to hit the Oppenheimer Rochester Fund alone. That fund is about as risky as you're going to get. Now, my guess is the reason you were sold or bought this investment is you bought it because of the high dividend it's paying. What you don't realize is this fund's down over 12% over the last couple months alone. That's a big loss. I firmly believe because this is a long duration muni bond fund and the higher risk on the end of the bond fund, if you hold on to this fund, you could subject yourself to even bigger losses down the road. The other fund you own is the PIMCO Total Return Fund. Bill Gross has actually done a great job managing that fund, but the days of the PIMCO Total Return Fund making any kind of realistic return like it did in the past, in my opinion, are over. I think if you've got your money mostly in those two funds, you are making a huge mistake, and I firmly believe you're taking on more risk than you should. What I'd recommend is this. Call the number at the bottom of the screen. I'll put my office number up there. We do have an office in Naples and in Fort Myers. Call my office for a consultation. Let's sit down. We'll talk about your risk profile. I'll show you how our objective and active management strategy works. We can help not only make you a return on your money, but also help you control the risk, which is probably why you're buying bond funds, but you're probably down over 10% in the last couple months alone. That's not risk management, and you are definitely on the wrong side of investing. I would seriously reduce your allocation on the PIMCO Total Return Fund, and I would completely sell the Oppenheimer Rochester Fund. That fund, to me, is a piece of garbage. It lost a lot of its value in 2008. And I fear that investors overload the boat on that one are going to lose a lot as interest rates slowly start to move up. Let's see, Neil from Naples. I have a significant amount of money in intermediate bond funds and also emerging market equities, I believe, that have taken a beating. What is your opinion of where to go from here? Buy more or sell or hold? Neil, great question. First off, Rezny Wealth Management right now, we have no exposure at all to any of the emerging market economies. Simple reason, they have been relatively weak all year. We actually had a small position in small cap emerging market at the end of July, and June, and sold it, the whole position. The reason we did, because small cap and mid cap in the U.S. kept outperforming and it was relatively stronger. What I would suggest to you is this. If you own most of your portfolio in emerging markets and in intermediate bonds, again, you're probably too skewed on the higher risk end of the spectrum. What I would suggest is you do this. You need to look at each one of those individual bonds, and I don't know if you own bond funds or individual bonds. I would not own bonds right now more than a 5-year maturity. If you own intermediate bonds, that's typically 10 years, 8 to 10 years or longer. I would reduce your exposure to intermediate bonds, and I would have no more exposure than 20% of my portfolio right now, with maturities no greater than 5 years of maturity. As for the emerging market, again, I don't know the percentage you have in these, but at the end of the day, emerging markets have been weak. And what I would suggest you do is reduce exposure in these two, and I would add equity-based investments, depending on your goals, into the U.S., which has been relatively stronger year to date, and I firmly believe as we gather steam throughout 2013, it probably will be the better place and asset class to be. I have to take a short break. I'll be right back. Please visit my website, ReznyWealth.com. And by the way, when you go there, we have a free report that I recently published. How to avoid outliving your money during retirement. It's only available at ReznyWealth.com. I'll be right back with your calls and questions after this. Hi, I'm Brian Rezny. If you're like many investors, you've lost a lot of your retirement assets due to poor investment management or being sold investments that are often better for that so-called advisor than you. Most so-called advisors are just salespeople or brokers for investments their firms represent. No real advice at all. If you're tired of bad investment advice and are ready for positive change for your retirement, call my firm for a consultation. Don't settle for bad investment advice. There is a difference. Call us today. Hello, we're back. I'm Brian Rezny, of course, the host of the Rezny Wealth Report. I'm going to put my website at the bottom of the screen. I know we're getting a lot of calls today with questions, and I'll give that number again. But go to my website, please, ReznyWealth.com. We've got a free report for all your retirees and pre-retirees. We title it, How to Avoid Outliving Your Money During Retirement. It is a must-read report for any retiree or pre-retiree who is serious about their retirement portfolio. And again, if you have a question about your portfolio, call the number at the bottom of the screen. I'm taking your calls now. When you call that number, a studio producer will take your question, and then I'll read and answer it on the TV here. So you get a straightforward answer. You get the right answer so you can make a better decision with your portfolio. Kevin in Fort Myers. I have an advisor pushing a variable annuity for my IRA, approximately $1 million. Is that a good idea? Kevin, absolutely not. First off, there's a lot of people in this business that call themselves advisors. The sad fact is 90% of these advisors really are stockbrokers that use a fancy title to mislead you. Do not ever put an annuity in your IRA. There's no reason to do that. The average variable annuity, Kevin, not only commands one of the largest commissions on the street, that's why brokers or so-called advisors love to push them, but the internal expense ratio every year is going to rob you of your returns. Not to mention they have mediocre investments in most of these variable annuities, high expenses, and back-end surrenders to get your own money. That's insane. What I would suggest is you only work with a fee-only registered investment advisor. You can call my firm for a consultation, but please do not put your IRA money into a variable annuity. You're insanely going to lock your money up for a long period of time with big back-end penalties, mediocre investments, and high expenses, often running 3 to 5% annually from the research we've done at my firm. If you're like Kevin, you have a question about your portfolio, please call right now at 239-417-4711, and I'm going to put my website up there. I know we're getting a lot of calls about our website. That's ReznyWealth.com. You can go there right now, get a free copy of our report, How to Avoid Outliving Your Money During Retirement. And of course, we're always taking new clients. Call my office number, schedule an appointment for a review at either my Naples or Fort Myers office. If you're concerned about your portfolio, if you're realizing set it and forget it, a passive asset allocation is not correct, or you're going through a change maybe and you need some extra help, call my firm for a consultation. There's a big difference when you're dealing with a fee-only money manager like Rezny Wealth Management, which we include risk management as an important part of the active management process. David in Fort Myers. What happens to my shares if I own stock in a company that files for bankruptcy? Great question, David. Simple. If a company goes into bankruptcy, you pretty much lose your shares. Your money's gone. At the end of the day, a lot of companies go bankrupt. And one of the things that I always stress to investors, if you buy stock, never ever own more than 5% of any one individual stock. So if, as an example, you decide to buy Enron, don't buy more than 5%. A lot of people got bamboozled into Enron, and Enron went bankrupt and people lost all their money. Eastman Kodak was another value trap. Investors thought Eastman Kodak, because it was trading at $2 or $3 a share, had to be a bargain. They went bankrupt. You, the shareholder, lost all your money. Never own more than 5% of any one individual stock, and make sure the reasons you buy that stock, you also have reasons why you're going to sell it in case a company gets into trouble like the ones I mentioned. Jeff in Fort Myers. In a recent column, you used the term 200-day moving average. What does that mean? Jeff, great question again. You know what? If you have questions about your portfolio like Jeff, please call right now. We're getting a lot of calls. We love getting your questions. Just call that number now. You'll give your question to a student producer, and I'll answer it on the TV. You'll get the correct answer to any of your question. Let me tell you about the 200-day moving average. The 200-day moving average basically is the average price of a security. I often talk about the 35-day, the 100-day, and the 200-day exponential moving average, not only on my TV show, but in columns and on my radio show in addition. The 200-day moving average, as an example, if I looked at the S&P 500, there's the daily price. Let's say today the daily price is $16.50. The 200-day average is the average price of the S&P 500 over the last 200 days. And the reason we talk about the 200-day moving average, it's a long-term average. Statistically, investments or stocks or investments that are above that 200-day moving average typically are in an uptrend, on a long-term uptrend. Investments that are below the 200-day moving average typically are headed into a downtrend. I talked about gold earlier. Gold actually went down below its 200-day moving average back around January, February of this year. If you would have followed the 200-day moving average and exited when gold, as an example, went below the 200-day moving average, you would have probably saved yourself about 15% additional loss instead of being a buy and hold investor who's ridden gold down 24% year to date. So we like to use the 200-day moving average. I always tell people, use charts in your decision-making process. A picture tells a lot. So if you look at a chart of a stock or a bond or a mutual fund, you can get an idea, is it in an uptrend or is it in a downtrend? One of the things I stress to every investor, never ever buy an investment in a downtrend, meaning don't buy one on the way down and don't add to an investment that's in a downtrend. Wait till it bottoms and you start to see that trend reverse. That's a great entry point. A great exit point on a long term would be the 200-day moving average. Take a look at that. It might help your portfolio benefit in less risk and possibly higher returns. Bill in Punta Gorda, Florida. I own 90% of my portfolio in mortgage REITs for income. What am I missing? Well, you're missing a lot of your portfolio in the last couple months, I can tell you that. Mortgage REITs essentially are basically companies that manage mortgages and usually leverage money anywhere from 10 to 20%. They borrow money, buy mortgages, so they basically have cheap money. They borrow money to essentially buy mortgages and leverage up the portfolio to get a higher return. My guess, the reason you bought a lot of mortgage REITs is you're looking for income. The problem is a lot of these mortgage REITs are highly risky. So again, don't own more than 5% of any one individual security, and certainly do not own more than 10% of any one individual industry. You own 90% of the mortgage REIT industry, which is crazy and risky. What I would do right now is I would trim your portfolio down to 10% mortgage REITs if you really have done your homework. The other percentage of your portfolio should really be invested in a better strategy that has a way to grow and give you income. The problem that you face is you're chasing yield, and there's a lot of retirees right now doing the same thing. The problem is you're going to get your shirt handed to you because you're taking too much risk. You seriously need to reduce risk in your portfolio and reduce those mortgage REITs down to no more than 10% of your portfolio. I have to take a short break. I'll be right back. Please visit my website, ReznyWealth.com. We do have that free report for you, How to Avoid Outliving Your Money During Retirement. It's a must-read for any retiree or pre-retire. And also, make sure you call my office for a consultation. As I always tell investors, there is a difference. We invite you to experience it. I'll be right back. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Do you know the biggest risk to your retirement and investments? One is entrusting your hard-earned money to someone who doesn't work in your best interest. The other is a lack of a detailed investment strategy to meet your goals. Both risks can be devastating, but both can be corrected. Rezny Wealth Management, fee-only money management. Don't settle for questionable investment advice. call my firm for a consultation. There is a difference. Hello, this is Brian Rezny. We're back and we're talking a lot about the economy, the investment markets. Of course, if you're a retiree or pre-retiree and you have a question about your portfolio, maybe you're questioning the advice you're getting. Maybe you're working for one of these Wall Street companies that use these fancy titles to mislead you into believing they actually work in your best interest. One of the things I try to educate every investor is simple. The only kind of firm you should ever entrust your money with is a firm that has a legal obligation to work in your best interest. Sad fact, most brokerage houses, Wall Street companies, broker-dealers, so-called advisors, insurance salespeople that sell annuities, the investment guy at the bank investment department usually worked under what's called suitability. They do not have a legal obligation to work in your best interest under fiduciary standard of care. Do you know the difference? If you want to learn more about fiduciary or suitability, and if you're being sold a bag of goods, go to my website, reznywealth.com. For free, you can download our fiduciary versus suitability questionnaire. Find out the facts that could save your retirement. Go right now to reznywealth.com. On the top of the homepage, you'll see fiduciary versus suitability questionnaire. It is free. It's a must-read for any serious investor. Linda in Naples, what do you think of the PIMCO Total Return Bond Fund? Linda, that's the second question today we received about the PIMCO Total Return Bond Fund. Again, Bill Gross has done a great job in the past. The problem is interest rates are starting to move up. I would not be invested in that fund. I think there's other smaller funds that have a different flash and flare that will be more nimble. One of the problems with his fund is simple. It's just too big. Too big is too cumbersome in this market in a rising interest rate environment. We would not use this fund right now at all. I believe he's a great manager, but you can't go on past returns because, again, past returns are not indicative of future results. That's a disclaimer you'll read in the prospectus. And when rates start going up versus going down, bonds and bond funds usually go down in value or have substandard returns. I think there's better places for your money, and that is definitely not a fund I would own today. Bob in Key West, Florida. I'm a retired investor. Is it time to consider a new investment strategy away from bonds? Bob, I love your question, and I'll tell you what, if you're a retiree and you have more than 30% of your portfolio right now in bonds, I believe you're making a huge mistake. And if that 30% you have in bonds or bond funds has an average maturity more than 5%, I think you need a serious overview of your portfolio. I think you do need a new approach, and I think the problem is there's too many retirees who got scared in 2008. Remember, every investment, bonds, real estate, gold, it doesn't matter. They go up and down in value. At the end of the day, what you need is an adaptive strategy that helps you reduce risk when you need to and add a little bit more risk when you should. The problem is investors, again, have the false impression that bonds are safe. Bonds can be just as risky as any investment, like the stock market, especially when rates are as low as they are. Ultimately, if you said to me, Brian, in the next 3 years, where do you see interest rates? Probably another point and a half higher than they are today. On an intermediate to long-term bond investment, you could see a 15 to 20% loss easily in the value of your portfolio. So no more than 30% and no more than an average 5-year maturity out on that 30 on average. John in Naples, can you explain fiduciary? I sure can. First off, Rezny Wealth Management is a registered investment advisor. We're not an advisor. That's what most stockbrokers and insurance people call themselves. They work under suitability. If you're a registered investment advisor and you're fee only like Rezny Wealth Management is, we have an obligation to work under what's called the fiduciary standard of care under the SEC guidelines. What that simply means is this. Because we work as a fiduciary, we always have to work in our client's best interest. Wall Street does not. Again, because they're not fee only and because they typically work under what's called suitability. Under suitability, it's legal for a broker and their firm to put their interest well ahead of yours. And there's many documented cases of this. Go to finra.org as an example and look up your brokerage firm and see all the complaints, fines, and censures. What I always suggest to investors is this. If you want a firm that has a legal obligation to work in your best interest and always do what's best for the client, that's the fiduciary standard of care. Under suitability, you are on your own, meaning you are responsible to do your own research and look out for yourself. That broker and his firm are merely a sales organization selling you investments that you're asking for. They don't have to be the best or the cheapest. In fact, a lot of times they can be just downright expensive and crummy, but suitability's been met. If you want to know more about it, more in-depth about fiduciary versus suitability, again, go to my website, reznywealth.com, and you can download for free that fiduciary versus suitability questionnaire at the top of the page. Jeff in Miami, what do higher interest rates mean for stocks? If rates move up slowly, stocks can actually go up. Statistically speaking, stocks can do quite well in a rising interest rate environment as long as interest rates aren't going up 2 or 3% every single year, which I do not think they're going to do. I firmly believe right now the asset to be is going to be in equity-based investments. Right now, relative strength-wise, bonds are lower on our totem pole and equities are higher up. You want to own relative strength. You want to sell relative weakness. So interest rates slowly moving up is okay, folks. It doesn't necessarily impact stocks on a negative way. I hope you got all your questions answered. I know there's a few more we didn't get to. We'll try and get to those on another day. Again, our website address is at the bottom of the screen, reznywealth.com. If you'd like to avoid outliving your money during retirement, if you want to sleep well at night, if you want less stress over your investments, and you want to enjoy retirement, you would benefit from a consultation with my firm. Call my firm for a consultation. There is a difference. We don't charge for the consultation, but call us. We have an office in Naples and Fort Myers. It can't hurt to talk and get a second opinion. If you're unsure, you're really getting real advice, if you don't have risk management built into your portfolio, call my firm for a consultation, and please visit my website, reznywealth.com, to download that free report. Until next week, have yourself a safe and profitable week.